Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all those boring corporate filings so you don't have to. Today we're diving into a report from Accruence Active Hedge US Equity ETF, and let's just say, sometimes less is more, and sometimes more can be well. Let's find out, stick around. Because this report has some interesting insights into how this ETF is navigating the market, especially with its use of options. So what we're looking at here is a semi-annual shareholder report for the Accruence Active Hedge US Equity ETF, or XVVOL for short, covering the period from the 1st of April 2025 to the 30th of September 2025. Think of it as a check-in to see how the fund performed, what it invested in, and any changes it went through. First off, let's talk about costs. For a hypothetical $10,000 investment, the costs for this ETF came out to about $45, which is 0.83%. It is important to remember this is an annualized figure, meaning it is what you'd expect to pay over a full year. As of the 30th of September 2025, the total size of the fund was about $1,758,000, or $1.76 million. That might sound like a lot, but for an ETF, it is on the smaller side compared to some of the giants out there. It held 53 different investments. The total advisory fee paid was around $14,911. And the portfolio turnover rate, which is how often they buy and sell investments, was at 92%. A high turnover can mean more trading activity and potentially higher transaction costs. Now, let's see where this ETF put its money. The biggest chunk, about 17.2%, is in utilities. This is followed by banking at 10.2% and then media at 9.6%. We also see significant investments in software and tech services, financial services, and consumer staple products. Interestingly, there is also a small allocation to purchased options at 0.3%, which hints at a more complex strategy. Looking at the top 10 holdings, we see companies like Entergy Corp, Brookfield Renewable Partners LP, and Robinhood Markets Incorporated. The percentage of assets in these top holdings tells us how concentrated the fund is. For example, Entergy Corp makes up 3.5% of the net assets. Having a few large holdings can amplify gains if those companies do well, but it also means higher risk if they stumble. Now, for a change that happened effective the 1st of August 2025, US Bancorp Fund Services LLC, which was doing business as Global Fund Services, no longer served as the sub-administrator for this fund. This is a back office change, but it is good to note as it indicates shifts in the operational partnerships that keep the fund running. Let's dive into the actual investments. The schedule of investments is where things get really detailed. We see the common stocks making up 97.6% of the portfolio. Within the banking sector, they hold companies like US Bancorp and Simmons First National Corporation. In consumer discretionary products, Tesla Incorporated is listed, and in consumer staple products, we see Universal Corporation. Looking at the financial highlights, we can track performance over time for the period ending the 30th of September 2025. The net asset value per S-share was $23.45. The total return for this period, which is not annualized since it is less than a year, was 17.27%. This is a solid return, especially compared to some of the other periods shown. For instance, the year ended the 31st of March 2025 shows a negative total return of 0.67%, and the year before that ended the 31st of March 2024 had a negative 0.40% return. So this most recent period looks like a significant rebound. Now, this is where it gets interesting. The ETF is also involved in written options contracts, specifically call options on the CBOE Volatility Index, or VIX Index. They've written call options with an expiration in October 2025 and an exercise price of $45. This type of strategy can generate income but also carries risks if the VIX index moves significantly against their position. The value of these written options is negative, meaning it is a liability for the fund. For the period ended the 30th of September 2025, the net change in unrealized appreciation on these written options was a loss of $1,853. The statement of operations gives us a look at income and expenses. For the period, dividend income was $37,602 and interest income was $487. After expenses, the net investment income was $23,127. The big story here is the realized and unrealized gain. They had a net realized gain of $388,448 on investments and a substantial net change in unrealized appreciation, adding another $166,693. This resulted in a net increase in net assets from operations of $576,415. The net realized gain on investments was $388,448. This means when they sold certain investments, they made a profit. This is a key driver of their positive performance in this report. And then there is the net change in unrealized appreciation on investments, which was $166,693. This represents the increase in the value of investments they still hold. So not only did they make money from selling some things, but the things they're still holding are worth more now than they were at the beginning of the period. On the options front, they reported a net realized loss of $84,115 on written options contracts. This suggests that some of the options they wrote were likely exercised at a disadvantage to the fund, or they had to buy them back at a loss. Going back to the financial highlights, it is really the total return that grabs your attention. The 17.27% positive return for the period ending the 30th of September 2025 is a significant improvement. The ratio of expenses to average net assets is 0.85%, which is pretty standard for active ETFs. Now, let's talk about why the Board of Trustees approved the renewal of the investment advisory agreement. They looked at the nature, extent, and quality of services, investment performance, costs, and benefits from the relationship with the fund. They noted that the fund's performance, while underperforming its benchmark index, the S&P 500 Total Return Index for longer periods, did outperform its peer group for the 1-year period. The expense ratio of 0.85% was noted as being above the peer group average, but the board concluded it was fair and reasonable given the services and strategy. This particular phrase highlights a lot of external input and analysis that went into the board's decision. It shows they are not just relying on the advisor's word, but also on independent research firms to benchmark the fund's performance and fees. They specifically mentioned Alta Vista Research and Barrington Partners, which adds a layer of due diligence. Ultimately, the board felt that despite some underperformance against a broad market index, the fund's performance was satisfactory given its specific strategy, and that Acruence, the sub-advisor, had the right skills. This is a classic balancing act. Acknowledging some performance gaps but finding them acceptable within the context of the fund's active management style and its goal of reduced volatility. Diving into the notes, we see the fund invests in a subsidiary Tortoise Cayman subsidiary I, which allows it to invest in certain derivatives like VIX options. This is a more complex strategy. The VIX index itself is a measure of expected volatility in the S&P 500 and can be quite volatile. By using options on the VIX, the fund is essentially trying to manage risk and potentially profit from periods of high market fear or uncertainty. The notes also detail various risks associated with options trading, including VIX options, collar strategies, vertical spreads, and covered calls. This signals a sophisticated approach to portfolio management, aiming to mitigate downside risk while still seeking capital appreciation. So, what is the verdict on Accruence Active Hedge US Equity ETF? This report shows a fund that has had a strong recent performance period, likely driven by smart investments, and perhaps favorable market conditions for its option strategies. The use of VIX options, combined with a diversified stock portfolio, suggests an attempt to navigate market volatility. However, the higher expense ratio compared to peers and the underperformance against the S&P 500 over longer periods are points to watch. The strategy is clearly complex, and while it delivered a good return this period, investors need to understand the risks involved, especially with derivatives. The fund's direction seems to be focused on active risk management, attempting to provide growth with reduced volatility, but the market's performance ultimately dictates success in the short and long term. Alright, that is our breakdown of Accruence Active Hedge US Equity ETF's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.